Good morning, everyone. Welcome back to Monica Point 8. Right, so for the S&P 500, well, it staged a major comeback on Monday's session, rising around 0.83% to close at 6,795 points. So the market erased a sharp 1.5% morning drop after Trump suggested that the conflict with Iran could be nearing an end, causing the oil price to plunge from the 120 back towards the $90 per barrel. So I think do expect a volatile but optimistic opening in Tuesday's session as the investors shift their focus from the war fears to the massive AI hardware announcements expected at the upcoming GTC conference, which organized by NVIDIA next week in San Jose. Right, so for the China A50 futures, it finished lower on Monday's session, falling nearly 3% intraday before narrowing the losses to close down roughly around 0.8% near 14,515 points. So the market faced a massive regional sell-off as the oil crude surged past 115, even 120 per barrel due to the escalating conflict. Though losses were cushioned by investors, hope for the aggressive stimulus following the 5% GDP target announced at the ongoing two session, right? I mean, do expect a highly volatile and also defensive trading session for today as traders continue to weigh the risk of global energy shock, right? So yeah, I believe this is the main focus for investors right now. All eyes on the crude oil price now. So the WTI futures had a wild roller coaster on Monday session, surging nearly 20% early in the day to hit the $120 per barrel. So I think this is the highest since 2022, 2021, 22, right? However, prices crashed later in the afternoon session, closing much below the $100 per barrel. So this price action left the long upper shadow on the charts right now, signaling that the war premium was heavily rejected. I think if you look into today's session, right, do expect an extremely volatile session as traders digest the sudden shift from the supply panic to the de-escalation hope. So at this juncture, we still keep our positive bias steady, eyeing for any further development from the war, which could further influence the price. So into Malaysia market, the FBM KLCI and also the FKLI futures closed lower on Monday's session or yesterday's session with the benchmark index falling 44 points or 2.55% to finish at 1674 points. So I think this was part of the broader Black Monday sell-off across Asian market, right? As global oil prices surged past $115 per barrel. So yeah, I think investors are now moving out of stocks and into safe cash as the war conflict intensify and the Strait of Hormuz remains closed. So for this, I mean, for our market, do expect a defensive opening in today's session as the market poised to test lower into the support level. Also for the FKLI, after the following the breakout, the bearish breakout yesterday, we have lower our support level and also together with our stop loss level to 1720 points. Right, so if you if you look at our Malaysia heat map right now, right? So yeah, I think the sharp decline followed a massive sell-off on the regional peers as well. And if you see here, our local banking sector took the hardest hit, which major players like Maybank, CIMB, and Bank all seeing a significant pullback yesterday. We also saw heavy pressure in the construction sector where Gamuda fell over 5%. However, it wasn't all that bad. The energy sector saw a massive surge with hibiscus petroleum jumping over 16%, Hing Yuan soaring around 12%, and as the investors taking benefit into the oil-related place. I think while the broader market is currently cautious, these defensive pockets show that there's still selective interest even in this current volatile market, right? So I think everyone is asking the same thing: how long this war could last, this conflict could last, and what does it mean for our Malaysian market, right? So if you look at the oil situation right now, I think we saw the oil spike to $120 per barrel, but it's already easing back towards below 100. Why? Because of the group of G7 is meeting to discuss releasing up to the 400 million uh, uh, barrel of emergency reserve, right? So that's nearly, I think, around should be 20 to 30% of their total stockpile. So I think the reality here is that Iran is playing uh, a long-term game, right? I mean, they are trying to win a traditional war, but they are trying to survive, trying to raise the costs, try to disrupt the shipping route. Also, some say that at the burn rate of $90 million per barrel, the financial burden is becoming massive for the um, uh, for the US, right? Um, Also, yeah, if you look here, in terms of our sector performance, all sectors in red except for the energy and also the plantation uh, sector. Also, we highlighted plantation and also the energy sector names lah, right? And also for our Malaysia trading stocks, we have United Plantation. So the stock is on its breakout formation higher at this 31 ringgit the 31 ringgit level on a strong volume. With that, we expect the momentum to keep bullish and the stock able to propel to test the next resistance at 33 ringgit and 50 cent, followed by 36 ringgit. And also, if the stock to clear below 28 ringgit and 50 cent support, this could reverse the course and make the stock to trend lower. Also, next we have TMT Chemical. So the stock is experiencing a pending breakout formation at 1 ringgit and 20 cent level. So if the stock to remain bullish, we expect the price to reach 1 ringgit and 26, 1 ringgit and 26, 1 ringgit and 26 in coming session with together with high volume. Second resistance at 1 ringgit and 32 cent level. So do keep an eye at 1 ringgit and 14 cent level for any attempt of reversal. Also, for the FCPO surge over 7% on Monday session to close somewhere around 4680 per ton, hitting its highest level over a year. So I think the rally was fueled by the again skyrocketing crude oil prices and also the expectation of the stronger biodiesel demand alongside projection that Malaysia's stockpile have fallen into 4 months low, right? Right. Once again, don't forget our campaign. Could stand a chance to win a Tesla and also iPhone 17 monthly. So trade more with us. Right. So I'll stop here and pass you to the next presenter, Max. Thanks everyone, and happy trading.
Right. Thanks, Simon. So we have a report on the energy sector earnings roundup for the last fourth quarter. So overall earnings were in line. If you look at in terms of the big market for the big cap players, which makes up more than market cap of 2 billion ringgit or 71% of energy sector coverage. These earnings were largely within our expectations. Among the big cap names, Tenaga and YTL earnings were in line. Tenaga mainly recorded a lower effective tax rate during the fourth quarter, which was in line with our expectations but ahead of Street. Hence, that's why we actually seen a number of earnings adjustment from the Street, given that management is now looking at effective tax rate of about 23 to 24% for the next few years, as opposed to the earlier guided 30% by management. We, of course, have already adjusted this into our numbers much earlier. Over at YTL Power, we also seen a much stronger contribution for its water segment, which helped to mitigate the softer power generation business as well. Pet Gas and Malakoff earnings were a miss. For Pet Gas, mainly because of higher OPEX, whereas Malakoff, they also saw a disruption at its coal plant, namely TBE, because of the whole fire incident during the fourth quarter. As for the solar and water names, I think solar, we deem both of these sectors to be roughly in line. So all the SolarWest, Simon as well, Right Here and Teleworks, we think that numbers were roughly broadly within expectations. But looking ahead, we continue to be quite have an overweight call on the utilities slash energy sector. We think that for Tenaga, the low ETR, about 23-24%, is likely to be sustainable for the next few years. And we also expect for Tenaga to ramp up their utilization of their contingency capex, which assuming if they can achieve 2/3 of the whole allocation for RP4, they can boost our target price for another 18%. We also expect better earnings ahead for Malakoff, given that the TBE plant should be resumed full operations from January this year. Hence, you should see full energy and capacity payments from the Tanjung Min energy plant. Apart from that, recall over the weekend that the Energy Commission also has called for a new RFP to build new gas plants for operation by 2029-2031. The tender will close in July. Hence, any announcement of the winning bids should be known by year end. We do think that YTL Power and Malakoff are front runners to build new gas plants, given their expertise, and also that they also have secured the gas turbines for that will see them build these new gas plants. In terms of upside, assuming a 1.4 gigawatt new gas plants, this provides about 6% upside to YTL Power and about 40% to Malakoff. But do know that Malakoff, if any new gas plants, essentially will be to replace one of the Tanjung Min plants, which will be expiring in 2031. But overall, for this sector, we think that it's a very good defensive sector should the market continue to operate in a risk-off mode. This given that both your big utilities, things like Tenaga and Petronas Gas, operate in a regulatory framework, which provides stable earnings and gives you about 4 to 5% dividend yield. In fact, if you look at in terms of historical, in terms of their KL Utilities dividend yield spread versus your MGS 10-year bond yield, during the COVID period, there was actually a positive spread as well as during the Russia-Ukraine war as well. So we think that if the geopolitical tension persists, the energy sector will remain quite a good defensive sector, thanks to your 4%, 5% yield. So I'll stop here and then I'll pass on to our next colleague to present his next report.
Hi, thank you, Max, and morning, everyone. So we have a transport sector result read this morning. So all three companies under our coverage reported the results that were in line with our forecast. To recap the quarter result, right, Westport full year earnings met our expectation at 103%, with the growth mainly comes from a record throughput of 11.3 million TEUs and a 15% tariff uplift adjustment. And for Tasco, their 9 months result met our expectation at 69%, but we deem the results to be in line as we expect a partial repair of their GHQ expenses in the coming quarter. And last but not least, FM Global first half result met 50% of our consensus estimate, thanks to a better operating margin and a lower effective tax rate. In terms of outlook, we believe that the Iran war has a limited impact on Westport volume, given that conventional cargo only make up about 6% roughly of their operational revenue in FY25. And based on our sensitivity test that every 10% increase in the fuel cost could reduce Westport FY26 earnings by about 1%. However, this could be largely mitigated if the cargo flows are rerouted or consolidated through an alternative Asian hub like Port Klang from the Dubai port of Jebel Ali. Following the closure of the Strait of Hormuz, which could potentially lifting the transshipment volumes in Westport. And notably, RHB economists expect a swift resolution to be achieved, in line with US President Donald Trump's indication that the conflict may last approximately 1 month. Hence, we believe Westport's earnings growth remains intact, premised on the back of the sequential tariff increases and a forecasted container growth of 4.5%. For logistic players-wise, they are potential beneficiaries of a higher freight rate, if there's any, because fuel costs, right, the increases are typically passed through to the end consumer. And so far, the freight rate was flat across most routes last week, except for the route of Shanghai to New York and Shanghai to LA. In addition, both logistic players under our coverage have a very limited direct exposure to the Middle East, with the shipments volumes to the region accounting for less than 2% of their total volumes. Hence, we maintain our neutral call on the sector, given that geopolitical uncertainties remain a consideration to us. Our top pick is Westport, and we continue to like the stock for number one, a clear earnings growth trajectory on the back of sequential tariff increases, and number two, container volume growth, which is leveraging a 0.89 correlation with the national GDP supported by stable intra-Asia trade. And last but not least, number three, the Westport 2 expansions remain the long-term catalyst to overcome their current utilization ceilings. I'll stop here and I'll pass the floor to the next speaker.
Hey, morning. We have an update on CelcomDigi. They've had a virtual call for a select group of analysts yesterday, myself included. Just very quickly, in terms of the key takeaways, the call basically touched on a couple of key issues. Number one is that the equity accounting of Digital National Berhad losses is still pending the fulfillment of certain undisclosed conditions preceded. The indication is that they will not be able to address all the conditions by end of June. So, it's a bit touch and go in terms of when they will start equity accounting DNB's losses. Now, they did provide some guidance in terms of what the impact will likely be should that be factored in. They've said that the potential dilution in terms of the FY26 numbers will be under 5%, so relatively manageable in terms of the quantum. DNB's losses have continued to improve on a year-on-year basis. Record losses after tax of 1.2 billion in FY24. You'd appreciate that the numbers are not within the public domain, so that 1.2 billion number is really from the company's commission website. So FY25 numbers have not yet been released as of now. Now, if we look at the guidance from management of less than 5% impact, it does suggest that the AB's losses may have narrowed to under 500 million to date. It's probably down by over half on the over 24's losses of 1.2 billion. We had previously estimated about circa 7% earnings dilution. This is based on a hypothetical halving of the AB's FY24 losses, assuming their losses are equity accounted from March. So we need to basically watch this space carefully in terms of their indications on when the losses will be booked. Now, equity injection to DNB, it's not ruled out. The last equity injection was back in May, 117 million. That basically brings total investment to over 600 million in terms of the current put option as well. So they're not ruling out that that further funds are required from the three shareholders to for working capital purposes and also to keep to sustain DNB's operations as it is. In terms of DNB's current position, it justifies an asset-light model. So I think leases in terms of site rentals and all that, they will continue to pay the MNOs. does it make sense for DNB to continue rolling out, their network on a standalone basis now that, there's a second access provider in terms of U Mobile in the market? So we've not made no changes in terms of forecast for now. Our forecast basically excludes the impact from DNB, pending further clarity from management. So the delay onset of losses from equity accounting may not be all that bad, considering that DNB's lower operational losses going forward, and there's also that specter of ongoing cost optimization, which in our view, it's something that's the right sizing will be good for DNB going forward. Note that the guidance from management, the official guidance from management in terms of the single-digit revenue and EBIT growth for this year excludes that of DNB as well as related regulatory developments. So no change there in terms of overall view. We're still keeping a neutral call, DCF-based target price of 350. Okay, I think that's all from us today. I'll see you again on Morning Kappa tomorrow. Bye.